Hey everybody, welcome to this free edition of our Trading Group Weekly Roundup for the trading week ending Dec 11, 2020. Well, will Santa be bearing gifts as we go through the holiday season this year? Hey everybody, I'm Preston Brent. Thanks for tuning in. Remember, don't be a rat brain trader. You want to be the red striped zebra, stand out from the herd, I guess. So let's kind of take a look at where we were this past week and just kind of what we can expect over the next few weeks going in. If we take a look at the performance this past week, you can see that just about everybody finished in the red here in the U.S. markets, with the exception of the Russell, just barely eking out a gain. Okay, we had the Dow, S&P, and NASDAQ all in the red, although year to date are in the green. And if you look at the PE ratios, we're still at a high forward 12-month PE of 25.85. And if you look at the dividend yield, the S&P, it's come in just a little bit, but it's at 1.65%. The 10-year Treasury pulled back just a little bit this past week, closing the week out at 89.3 basis points, which is almost just slightly under 1%. The spread between the 10-year Treasury and the dividend yield is still a healthy 0.75%. You know, 75.7 basis points. So it still kind of channels money into the equity markets. And volatility was up for the week, a little over 12%. It moved up from 20.79 to close out this week at 23.31. And if we look at the best performing sector, energy, still doing well this week, up 2.25%. The worst is financials, coming in the red this week at 1.32. You can see the annual sector performance. Technology has obviously been leading the way for most of the year, up about 36.98, call it 37% for the year. Energy bringing up the rear still at 27.92%. It's been bringing up the rear all year long, but I remind you that it was underwater a little over 50%. It's made up almost half of it so far. And then if we look at the world market performance, some of the other major indexes around the planet, all in the red this week. FTSE CAC 40, DAX, Nikkei, China, Hang Seng, which is Hong Kong, all in the red for the week. The only year-to-date performance winners now are the Nikkei and China. If you remember last week, the DAX was just barely in the green year-to-date, but it went back into the red with this week's performance by the German index. We like to follow Germany because it's really the market moving country over in the 19 countries that make up the euro. So that's a little bit about where we're standing. Now, let's just kind of take a look at it and break it down just a little bit. Let's look at the weekly sound bites and let's look at the market performance for this past week. Well, as I said, all of the indexes early in the week hit new highs. And as we went through Wednesday making new highs, most of them pulled back, though, as we came towards the end of the week. But the Russell, small cap Russell, has kind of been leading the S&P 500 for 5 weeks in a row now. And it recorded, as I said, as you saw, just a small gain for the week. We did see IPOs with Airbnb and DoorDash. Those are the largest IPOs so far this year, 2020, rising pretty good bit on their opening. DoorDash almost being a double. Airbnb was a double. 2020 is on track, by the way, to be the highest volume and busiest IPO year since 2014. Okay, we did get positive vaccine news earlier in the week, kind of giving investor sentiment an early boost. But then we got possible delays in the US Fiscal Stimulus package from DC, causing price action to kind of move a little bit lower. All right, so that's kind of what we're getting here. And then if we look at the economic data, we're getting the impact of the latest wave of infections here in the U.S. kind of evident in the weekly jobless claims. This past week, it jumped from 716,853 with more lockdowns and shutdowns across the country. Fortunately, down here in Florida, you'd never know there was a pandemic going on. Everything is fully open and rocking and rolling. But we've had the highest level of weekly jobless claims in 3 months, coming in at 853,000, as I said. Continuing claims also rose to 5.53 million, or last week from 5.53 up to 576. So that's breaking a streak of continuing claims declines going back to early September. And also the rest of the week's economic data was kind of mixed. I mean, we did see vaccine optimism in the University of Michigan consumer sentiment. It moved up in November. It's the second highest level since the onset of the pandemic. So consumers seem to be still optimistic about this vaccine and being able to get things back to normal again. U.S. Treasuries, as I showed you earlier, the yields came back down just a little bit, most of it amid uncertainty of this fiscal stimulus. Okay, and then we've got a little bit of uncertainty in the Brexit trade negotiations. We are getting a lot of money coming back into municipal bonds as well. But the worsening coronavirus situation, a little bit more of the bigger outbreak, and the lack of progress in the fiscal stimulus kind of really created a little bit more uncertainty, which drove the yields down just a little bit. All right. But we've got a Fed policy. Keep in mind, our current Fed policy supports very supportive of banks, as we've seen in the rise in the yield curve. All right. It's also designed to inflate stocks, right? That's why we got such a high PE ratio, and it's designed to reduce volatility, which, as you saw, currently came in at about a little over 23 for the week. The average 2-decade VIX reading is around 19. We're at 23 right now, but I suspect that's going to kind of drift lower as we go through the end of the year. Okay. Now, speaking of the Brexit, if we just kind of talk about that real quickly, it's kind of like that toilet paper that sticks to your shoe, bottom of your shoe, and it just won't go away. Even if you step on it, it just breaks off, but it still stays stuck to your shoe. I mean, we're getting talks between the British PM Boris Bulldog Johnson and the EU this weekend so far has failed to break any deadlock over a UK-EU deal, right? Both parties agreed to set a final deadline of this Sunday, but how many times have you guys have heard this is a final deadline? It's like politicians just do what they do. There's really not final until it's over, right? But they set, according to both parties, a final deadline of Sunday for the negotiating teams to make one last attempt, okay? And Bulldog Johnson came out and said there's a strong possibility of no deal at all. So that's going to tend to create a lot more agita in the British pound, move it down a little bit, move the euro down a little bit, increase the value of the dollar index if they get a no deal kind of thing. Meanwhile, the EU did pass, on a bright note, more money, 1.8 trillion budget, which includes about 750 billion euro in a coronavirus recovery fund for 2021 through 2027. So again, more money is being thrown at the markets, and the markets, as you guys know, near term certainly love more money. And then of course there's China. Equities fell in China pretty substantially, and renewed tensions with the U.S. after a second major index provider started removing Chinese companies from their benchmarks, right? And this is following Trump admin's executive order. Also, concerns that the U.S. sanctions will target more Chinese companies kind of outweigh generally positive data for money, credit, and merchandise trade out of China. So all of these are driving the Chinese markets down. Now let's just kind of switch screens here. I'm going to move it over to the charts here. We're going to start off with the Russell small cap. Let me just move this thing over here like this. Let me get it over here, and I'll wait for it to pull up on the screen for you guys. Takes a little bit of time. But what you're going to be seeing is the Russell cash index. And you're going to see here that we are sitting at all-time highs that were made in the middle of this week on Wednesday, 1935. And you can see here, as late as the beginning of November, we were down around 1543. We were actually underwater almost 7% in the Russell. And then from that 7% down, the Russell index has basically moved up year to date about 14%. So almost a 21% move in the Russell index. Just amazing. You look at the MACDs and divergence. There is no divergence in this. This does suggest any dip is going to be bought. Okay. We've got from an Elliott wave count standpoint, an Elliott wave 3 that does suggest I would expect a little bit of a pullback, possibly down to the 1821 level. If I were to use my system to help me guesstimate it using Gann and Fibonacci, it'll draw it on the screen for me. and it'll say right around 1818 is a near-term possible pullback, and 1720 a little bit further term, using a combination of Gann and fib nodes. But you can see here what we're looking at. And that just basically goes in line with what I've been telling our members here for the past couple of months. We've had this cyclical rotation, our sector rotation into cyclicals, industrials, small cap. FANGs have been running sideways for quite some time. If we look at this specialized FANG index that I have here, the last all-time high we had here in this was back in early September, September the 2nd. Okay, this is an index that's comprised of Microsoft, Facebook, Apple, Netflix, Google, and Amazon. I've got a weighting factor for each that just kind of gives us an approximation of how all of these groups of stocks are trading. Okay, and you can see here that it's just been running sideways. Okay, and we haven't gone anywhere in these. But if we look at other stocks, they've been moving higher. If we look at the equal weight of the RSP, which is S&P equally weighted, you can see here, and I'll just move this up like this. Excuse me. Got the sneezes. You can see here we made all-time highs here. Now, if I go to the ratio charts, let me just come over here and just ratio chart this thing. And you can see here on, let's see here, equal weight RSP to the SPYs. Look at this. It's just moving higher. And it really started in early September, right? When the FANGs reached their all-time highs and then just started pulling back and running sideways. And you can see away we go. And looking at this chart, the reading, I've got RSP, which is the equal weight S&P in the numerator, and the SPY in the denominator, and anything moving up means the equal weight S&P is outperforming the weighted as the SPYs. Okay, just really amazing here. And this just shows this rotation has gone on. Now, we had this rotation in 2019 and Q4 2019, but it only lasted about 6 weeks. This thing's been going on since the beginning of September. All right. And then if we look at growth and value right here, you can see this chart has been going down. Growth is in the numerator, value is in the denominator, which means the denominator on a relative basis has been increasing faster than the numerator. Therefore, value has been outperforming growth. But again, you've seen it on all these other charts. And we picked this up for our members, and I showed our members how this thing is playing itself out, right? If we look at it another way, if we look at the equal weight Qs versus the QQQs, so if you take QQQE, which is an equal weight of the entire NASDAQ, or the Qs, and then we put in the denominator just QQQ, you can see the exact same thing here. Everything is lining themselves up, right? Values outperforming growth. We're getting that cyclical move. Should not be surprising. Now, as we go through the end of the year, I've been telling our members that I was expecting a little bit of a pullback. Now, we have had some. If we come down here and we look at the S&P 500 E-mini futures, let me just pull it on the screen here. You can see here, let's just zoom in so you guys can see it. We hit a little bit of my target right up here, 37.14. My near-term target was anywhere from 37.25 all the way up to 37.50, and I said I could see the momentum carrying us up to 3800. I'm still holding to that right now, okay? But we did come up and hit the lower end of my target, which was, again, 37.14. I mean, just right on the lower end, just touched it nicely. Now, we closed out the week at 36.52, right? And if we divide these two together, we get a pullback of just only a little over, just about 2%, really. And I was expecting about a 5%, maybe 7% max. And then we're going to make another run, take out this 37.14, run up to 37.50, maybe 3800 before we get more of a pullback in February, March timeframe that could run us 10 to 15% pullback. Okay. For our members, I'll go through that with you guys this Sunday evening, but this is kind of what I'm looking at right now on the major index. If we look at the transports, right, I showed this to you last week. If we look at the Dow Jones transports, the ETF that tracks it, again, New highs that were made on Wednesday, right here. Let me just zoom it out a little bit. We're making new highs in the transports. You don't make new highs in transports and new highs, all-time highs in the Dow at a market peak, right? Generally, the transports start falling 60 to 90 days before the rest of the market follows suit, right? But that's not happening. So again, any pullback here is going to be bought. I still think we need a little bit more of a blow off kind of top before we get a further, deeper, correction type of move, which would be over 10%. Okay. I'm not expecting a bear market pullback. I'm expecting a 10 to 15%, at least a correction sometime in Q1. Okay, I mean, that to me would make sense. Now, if we come down here and look at volatility, you can see the VIX right now moved up just a little bit, right? It hit a low down here, the lowest closing low was right here at 1997. It actually closed at 1997 on one day on the 4th, a little over a week ago, but I just don't see it staying below 20 because we got a couple of binary events coming up. The primary one is going to be the near term. Everybody's focused on the stimulus. If we hit a stimulus, that's going to move us back up and just totally reverse volatility and move it back down lower, and we'll see the equity markets come back up again. Or we got the vote coming up in Georgia on, do the Republicans maintain control of the Senate, or is it moved over to the Democrats? Okay. If the Democrats take control, I think we'll have a bigger sell-off. That sell-off I'm looking for may be moved forward in time, and we'll get that. If the Republicans control it, then the markets love a blocked market where the Republican Senate will keep Biden in check, and the only thing he'll be able to do is executive orders because it's got to go from Congress, which the Democrats have a very, very small majority, which I don't know if Pelosi will be able to control that, but it doesn't really matter. Whatever she gets over to the Senate, the Republicans will block it from getting to Biden, and then Biden will be forced to do some kind of executive action, which half of them will probably be challenged in court. Things will be tied up for quite some time. The market's like that. The market's like it when politicians can't go in and change things. It makes the future a little bit more clear rather than very ambiguous as it is right now. So we got a couple of binary events that could move markets a pretty good little bit. We got to pay attention to them. And then, of course, if we look at the bond market, right? Bond market is flat right now, but it has been moving down. Notice this red line is the 50 EMA. And every time we get at it, on it, or slightly above it, we move back below again. We've only closed one time above the 50 EMA, and that goes all the way back to August. We move up intraday, like you can see here on the December the 1st, but we immediately go back below. We're sitting just slightly below it right now. So if we move back up, I would like to see a little bit of a move higher, because then I would be willing to short the bond market and play it. But if we do get that correction in Q1, we're going to see bonds run up, and it'll be definitely worth a short at that point in time. Okay. If we look at the currency market, well, the dollar and the euro are doing exactly what I've been telling you guys. If we look at the dollar, we came down and we hit my low. Remember, I've been talking about the dollar coming down to this point down here since early November. I said it's low-hanging fruit trade. Now, with our members, I walked through some ways to do it. And our option masters, I've got some wonderful ways to play the euro to the long side, right? Or the dollar to the downside. And you only need to trade one of them. You can just trade euro long. It's the same thing as trading dollar short. And you can see here, we're sitting at this low here. I do believe we may get a little bit of a tilt higher in the dollar if we get that correction in Q1, but that'll be worth shorting if it does get up off the ground. And then the euro, if you guys remember, I said it's going to hit 121. It went right through my target. It's at 121.79, so almost 122. I think that the euro is not done. Any pullback is certainly going to be worth buying. If we look at the British pound, it's just, look at the chop here. It was moving up to my target, but I said it's going to be very choppy with the Brexit. Now, what I believe is going to happen is if they come out with a hard Brexit, the news is going to move this down. There's going to be some fear in that. I do believe longer term, the Brexit, once they get things sorted out, is never as bad as they projected, just like the Brexit vote itself going all the way back to the summer of 2016 when they voted on it. Hard to believe it's taken these idiots this long to work through this thing, but it has. And so now I think it may come down a little bit lower, but I think longer term, the Brexit is a long term buy, right? I just think the buy-in on the Brexit. I think the longer term, the pound would be just, it's going to be much higher than where it is. I think it can go lower on any negative views and a hard Brexit, but it'd certainly be worth a buy longer term. That's the way I would look at it. Okay. Now, of course, if we come down here and we look at gold, I think short-term gold is can still go lower. You can see every time it hits the 50 EMA, which is that red line. Remember, gold is a very technical trading instrument or an asset. It tends to follow the technicals very well. And I do believe you can see here where it bounced off the 50, coming back down. It may challenge it again, but I am not willing to go long gold unless we can take out this pivot over here at around 1940. And I just don't see it happening, right? I really don't. Same thing with silver. Silver is not as bearish as gold. You can see silver has been running a little bit sideways, coming all the way back to middle of September. Gold has just been kind of slowly going lower. But once these things start to catch on again, I think silver is going to be the place to be. Remember, we played this big move right here in silver really well. And the bet was to be long silver versus gold because on a relative basis, silver outperformed. And that was our bet, and we did really well in it. Now we're just in this long consolidation period here. So that's kind of what I'm looking at on these two. Now our trade of choice, and I kind of offered it up here free for you guys in our weekly roundup, is copper, right? You can see copper here. It's just a beautiful trade. We got in way back over here in early April when I said the world economy, if it gets stronger, copper is going to do well. You can see this trend line here. We briefly fell below it, below the 50 EMA. You can see a test of the 50 EMA right here, and it's just hard buys all the way up here. No divergence in the MACD. Any pullback to this trend line or maybe slightly below is worth buying. We traded this two different ways, one in copper futures and the other in Freeport-McMoRan. If you look at Freeport-McMoRan, same thing. It's a little bit more extended. We got into this around the low sixes, and now it's sitting at 24.61. That's a 4x move, guys. And we've just had a fun one in Freeport-McMoRan. So these were trades that I put out a list of 10 stocks you got to be long on the fourth week of March, going into the end of March. I just said there was just too much overdoneness here with this thing, and you got to be long some of these things. We picked some travel and leisure, hotel, food distribution, transport. I mean, there's just some of these things you just got to play, right? You have no choice. Hold your nose and take them because you're going to do very well, and we have. Now, if we come over here and we look at the energy markets, oil here, as I mentioned before, it's just really on a tear, but I think it's running out of juice up here. It could run up to 50, but I think it's going to be running out of juice. So doing unbalanced flies and condors on this thing, to me, make a lot of sense. Even front ratio spreads with calls in the options market on the futures make sense to me, right? Just keep the trade small, take your profits quick, and I think you'll do fine in the oil market. And of course, if we look at nat gas, it's trying to make its way back higher, but I think any move higher around the 50 EMA is probably going to be sold off again. Right? I don't see that holding its own. And if I move this over here, and I'll just put it at the last pivot high right here, like that. In fact, what I'll do is I'll move it over here like this, and you'll see that pivot high incorporates this just a little peak right here. I don't see it coming back up over 3. 3 is a magical number for nat gas. I don't see it up there. You can see there is no divergence in the MACD. This suggests the 200 EMA did hold the yellow line, but I don't see it getting too much higher. Any move higher, and we're going to short it. All right, everybody, that's kind of where we are in just some of the major markets. Members, I will see you this Sunday evening. We'll go through details, some other stocks I've got picked out for you. If you're not a member, highly encourage you to come in and join us. Have a great weekend, everybody. See you later. Ciao now.